Bitcoin, ETFs, and the rise of Pi. The turning point in the global monetary order. When Bitcoin was first introduced, it carried with it a revolutionary promise: the ability to exchange value without relying on banks, governments, or intermediaries. The idea was elegant in its simplicity. Trust could be coded into mathematics. Instead of middlemen, blockchains and algorithms would serve as the guarantors of fairness, security, and transparency. And yet, fast forward to today, and we find ourselves in a world where Bitcoin and other cryptocurrencies, originally designed to escape the grip of centralized finance, have been dragged right back into the very system they were meant to disrupt. How? Through ETFs, exchange-traded funds. The irony of ETFs. An ETF takes a decentralized asset like Bitcoin, wraps it into a financial product, and sells it on Wall Street. Suddenly, the revolutionary peer-to-peer currency is no longer in your wallet but sitting in the custody of fund managers, brokers, and banks, the very institutions that Bitcoin was designed to bypass. The irony is striking. A system meant to eliminate middlemen is now controlled by them again. Intermediaries have returned in full force, charging management fees, restricting access, and extracting rent from assets that were once supposed to belong to the people. Instead of liberation, we see reabsorption. Instead of decentralization, re-centralization. Assets born to dismantle middlemen have been captured, repackaged, and brought back into the heart of the legacy system. The problem with first-generation cryptocurrencies. The Pi Network white paper recognized this flaw from the very beginning. It pointed out that Bitcoin and its peers, despite their promise, quickly became plagued by concentrated mining, wasteful energy consumption, and speculation-driven economies. In Bitcoin's early days, mining was simple. Anyone with a personal computer could run software and be rewarded with 50 BTC for their contribution. It was fair, open, and accessible. But as Bitcoin grew in popularity, clever miners realized that more machines meant more rewards. Soon, individuals were replaced by corporations. Specialized hardware known as *A6* took over the landscape. Mining farms, massive data centers filled with these machines, sprang up around the world. The so-called Bitcoin gold rush quickly led to centralization. Everyday people could no longer compete. And then came the environmental cost. These enormous farms consumed vast amounts of electricity. Some estimates suggest that Bitcoin mining today uses more energy than entire nations. What began as a decentralized dream transformed into an industrial-scale operation, dominated by a handful of corporations. The result? 87% of all Bitcoin is now owned by just 1% of the network. Companies like Bitmain have made billions in revenue, profiting not from decentralization but from control. What was meant to democratize finance ended up recreating the very inequalities it sought to solve. Pi's alternative: a trust-coded system. By contrast, Pi Network took a different path. Instead of relying on raw computing power, Pi built its foundation on people. A KYC-based, verified human network ensures that every participant is real, not a bot or a server farm. Rewards are distributed not based on who owns the biggest machine, but on contribution, securing the network, validating trust, and growing the ecosystem. Smart contracts and automation replace intermediaries. The very things that ETFs reintroduce, fund managers, brokers, custodians, are unnecessary in Pi's design. Trust is built directly into the protocol. The system itself guarantees fairness, security, and transparency. In short, where legacy finance and first-generation cryptocurrencies fall back into centralization, Pi holds the line, preserving the spirit of decentralization while avoiding the pitfalls that doomed its predecessor. ETFs. A financial bomb waiting to explode. But let's return to ETFs. Why are they so dangerous? At first glance, ETFs appear to be a success story. They provide liquidity, allow mainstream investors easy access to crypto, and even help drive prices higher. But beneath the surface lies a structural fragility. ETFs act as liquidity funnels within the legacy system. Money pours in and out of them, connecting crypto markets with traditional finance. But in times of stress, these very funnels can magnify risk. If ETFs collapse, the shock doesn't just stay in crypto, it spreads through the entire financial system. Investor losses ripple outward. Banks, brokers, and funds all face mounting stress. Liquidity dries up. Credit contracts. A single spark in the ETF market could trigger a chain reaction leading to a system-wide crisis. This is why some analysts describe ETFs as financial bombs, contradictions embedded in the system, waiting for the right conditions to explode. A warning of crisis.